Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Hi, welcome to episode number 4. I am your one of your hosts, Justin Bogard, and my other host is Mr. Richard Thornton, who you'll see on in just a minute. Today, we're going to be talking about the travails of setting up a fund, what has happened with the people, the naysayers, on the recession that was supposed to happen here soon, or the economic downturn, and how was your Valentine's Day? Stay tuned. Travails is my new word, Richard.
All right. Are you sure you want to talk about Valentine's Day?
Yeah.
Oh, man.
Yeah, you had led me to believe that you and your significant other Gita were going to the beach. And you're going to have a nice little romantic afternoon at the beach on Valentine's Day. Did that happen?
No.
Oh my God, Richard, did you forget?
We did not forget. It was for our area cold and miserable. It was overcast. The wind was blowing like, you know what, all around. And we looked at each other and said, I'm not going down to the beach and freeze my tail off. So we did not go.
Well, that makes perfect sense. So you had audible there.
We had to come to our senses. Yes. Romance was not going to blur our vision regarding that.
So you just put on the big screen a picture of a beach with the waves crashing, and you just sat in front of it and said, yeah, this is much better.
Yeah, actually, we got in the hot tub, and that was kind of nice. Yeah.
Ooh, interesting. Okay.
That's a Northern California thing, right? It's hot tubs, right?
This is PG. We got to leave it at that.
Well, I didn't go there.
Richard, that is awesome. So my daughter's got some candy and some stuffed animals. I haven't done flowers for them yet. Number one, because they're transitioning between me and their mom's house, every other week and stuff. So I didn't think flowers would be that good because there's no really continuity for them to stay. But when they get older, I think I'll do flowers more. But right now, they want the candy and the stuffed animals. They love that stuff.
Yeah, my kids never, especially my daughter, never was much one for flowers. It didn't work quite so much. But what really worked, and what I read a very interesting article in the paper about this last week, was the little heart candies. They say "Be mine" and "Love is yours" and all those things. And there's a whole science behind that, sort of like fortune cookies, about what to put on there, and it's worse than a tweet. You don't have 140 characters. You've got about 15 characters.
It's true.
And so you've got to get your point out there very directly. There's none of this long conversation stuff. It's, be mine or it.
Love, LUV. So
that's
LOV.
right.
They even abbreviate it so quickly.
That's right. So we could do a takeoff of like what we do with text messages, right? Rather than writing out "CU," we can just put the letter C and U, and then
or "I heart you."
That's right.
Yeah.
How do you do it?
That's for you, Richard. Is that the heart?
That's right. That's right.
There we go. All right. So we are not in a recession, are we?
Last time I looked, no. As a matter of fact, I think the economy is saying "nanny, nanny, boo, boo, we fooled you" to a lot of the pundits, because the Fed was going in and tightening down things and trying to drive us not into a recession, but slow us down as much as we can. And I was reading just yesterday, and unemployment's at 3.6, one of the lowest that it has ever been at. And they are now calling the Great Resignation the Great Reshuffling. in that a lot of people, they said, well, it's not that a lot of people resigned during the COVID. They had time to reassess. And to use a good example from my neighbor, who is a restaurant owner, his executive chef quit. And since restaurants were closed for the first part of COVID, I say he quit. He quit post-COVID, but he didn't come back into the profession because he had time to sign up for one of these computer coding classes for a year, and is now making 3 times the money that he would have being a chef. And he's only working 8-hour days as opposed to 15-hour days. And there's a whole lot of that reshuffling going on.
Yeah.
That's very interesting.
It's very interesting. So we're not in a recession. Real estate seems to be doing pretty normal.
Yes.
Nothing major flopping in the worst direction or gaining in the super appreciation right now.
That's right.
So a lot of people looked at 23 and 24 being kind of probably going to be a down year to expect it. I don't know what I thought at the time when that information came out. Maybe I saw that in late 22 or maybe early 22, or I'm sorry, late 21, early 22, when I saw some information come out from people that I respect and know in the business, because that's the information they had in front of them that day. And they
Right.
said their projection was like, yeah, it's probably not going to look that good. But you're a weatherman at that point, aren't you, Richard?
You are a weatherman, and so to your point, as you know, we're raising monies for the fund right now.
Yep.
I had several people say, look, we're coming into a slowdown, some sort of recession here. I'm going to sell now, and Richard, I'd like to take the proceeds of all that and put it into your fund. Well, I talked to a guy just yesterday from your area, and he says, I got 15 houses that I'm renting out. And he said, my rents haven't fallen. Matter of fact, I raised my rents a little bit.
Yeah.
And my housing prices have dropped maybe a little bit, but not much. And he says, I'm going to hold on. Makes it a little bit tough for us raising money, but I'm glad for him, because there's a lot of people, I think, that are in that same boat where prices did accelerate exceedingly.
Yeah.
You and I found this out when we're trying to generate privately held notes, where I thought a lot of this run up was just due to San Francisco and maybe in Indianapolis and larger metropolitan areas. We found out that it was in podunk America. I mean, Louisville in the middle of Kentucky is all of, they've got 30% increases in their housing values. So they're going to hold on to them. Why not?
Why not? Yeah. Why not? Makes sense, right?
I think so.
Travails.
Yes, there are travails out there.
Richard teaches me these words, and then I start using them, and I probably use them incorrectly, but I just like how he comes up with these words. Sometimes I really think they're made up, and I have to challenge him. What's that game that you can challenge people on a word? Is it Scrabble, where people make words and then and then they say like, oh, this, I can't even think of an odd word, something that comes out of your mouth, really.
Yeah. Yeah.
And so I have to start using. So Richard told me about travails just before we got on the recording, and so I just had to start using it to make myself sound more intelligent there.
You learn things about your significant others about things like that. Yeah. Not that you're my significant other, but
sometimes it feels like it.
Let's not go there. Business partners only. But anyway,
I'm your significant business partner.
That's right. You're my significant business partner. I used to have this woman that I ran a company with, and we said we had a business marriage, because we were, you bicker and you do everything. It's like you do in a marriage, but it's just for business. Anyway, Gita, as you have mentioned, my significant other, loved playing Scrabble with me.
Okay.
When we first became a couple, and the more I played, the better I got. The better I got, the more I started to win. Now she won't play with me anymore.
It sounds like
she said, I had a good time playing as long as I was winning, but I can't win anymore.
It sounds like I need to help her out and challenge you on some of the works that you come across.
No.
So I may have to team up with her against.
You may have to, yeah. That's funny.
Richard, we brought up the word travails, and we had a good time poking fun at that word a little bit. And so I appreciate you being humorous with us there. But when it comes to setting up a fund, there are many people in real estate, whether they're in the note business or traditional real estate, they think that's what they should be doing. And it does make sense at a certain point to have a fund, right? And it doesn't at a certain point as well. So if you're just starting out in the business, it's apparent you shouldn't set up a fund because you really haven't experienced all the trials and tribulations of the real estate investing that you're doing. But there does come a point to where you have that pivot, right? To where you're like, okay, I do really well. I raise some private money. I do one-to-one deals with people, but starting to become more apparent that I need more money, right? And I'm coming across more deals than I am money. So it's like, do I continue to find the one-to-one relationship partner with match a deal with a partner, or do I start raising a bunch of money now and don't worry about the one-to-one partnership and just have a big surplus of savings, let's just say, and to go after these deals? So that's kind of step one for me. Is that how you see it happening?
Yeah, I think that's the allure.
Ooh, I actually know that word.
That's another word. How about that? I think that's the sparkle that a lot of people have in their eyes. They have to, as a matter of fact, there's somebody that you and I both know right now, and they're talking about setting up a $20 million fund. And I don't think they're quite balancing out how they're going to do that, how they're going to get from point A to point B, because it's a lot more difficult than you would think. That's sort of what it comes down to. And it's not necessarily the big stuff. You can get a lawyer to draft your documents and all that stuff. But tell me one of the things in setting up our fund. Give me 2 or 3 things that you have found to be much more difficult than you thought.
Well, I think it's the how it works, the functionality of it, the triggering one event to cause another event to happen, understanding from the investor standpoint, someone that's pledging capital, because they're pledging their hard-earned money and trusting that the process is going to work and what they're investing in is going to be, a sound fund that's, very secure. It's low risk to them if that's the type of fund that they invested in, and to make sure that they get their return. So there's a whole operational flowchart diagram of how this works, even at the simplest level of a fund. Because you don't want to look like an amateur when you do this, right? You want to look like a professional. You want to have it set up correctly. Obviously, you mentioned using an attorney. That's the easy part, right? You hire an attorney, say, draft my documents. You read the documents. It's very lengthy, but you need to read the documents and understand what you're doing. But then setting it up operationally, it can be challenging because you have to kind of figure out, I never thought about this, because I have to have a reporting process, right? When I give distributions to investors, I have to, think about, okay, I need to manage this money in a certain way because there's a cost of doing business for us as the fund manager. And then there's, inventory that we have to go after, or assets that we have to go after to make sure that we meet a certain threshold price point so that we can pay the debt service and also make a little bit of money as well. So those things are a little bit more complex, and everybody's situation is unique for a fund manager. But that would be the first thing to come across my mind, Richard, when you asked that question, was just the operational foundation of how the structure works internally.
Yeah. So for those of you who don't know, in our fund, Justin runs more of the operations and I run more of the marketing. I've got a bigger mouth, so I can be a marketing. Right?
You got fancier words, that's for sure.
Fancier words, right?
Allure, travails.
Allure, that's right. Just a bigger mouth. At any rate, and so one of the things that I think we immediately thought of on your side, and was very obvious and simple to talk about, but then how do you get into implementation?
Yes.
Of putting it together is that when we set up the website, first of all, we had to have 2 websites. We wanted to have an investor website and a seller website. Yep. And they had to have very different, they had to be positioned very differently, because we want a seller to go on and say, all right, Here's my website. I want to get my information in there because I want to quote, bam, bam, bam. And you're not, trying to talk that person into investing or anything. They may be an investor, but for the most part, they want to get in, get their quote, know what we're going to do, and move on. So how do we implement that? Well, as you know, we set up input on the website.
Yeah.
That data has to feed into the CRM. It also has to feed into the loan servicing management, and all these things have to be all wound together. Easier said than done.
Yeah. There's no manual for it, right? It's kind of, you have to walk through it in your mind. You have to set up, like I mentioned before, some sort of flow chart or some sort of diagram that just kind of tells you, okay, this is step one. How do you get an investor, right? Where do you find the product that we're buying with the investor's money? So we kind of have two clients, right? We have an investor client, and like you mentioned, we have a seller client. So we need to have, we need to appeal marketing to two different types of individuals, two types of investors, two types of LLCs, whatever the case may be. And then we have to go find the product as well. Then we have to manage it all too. So it becomes a complex machine, and I don't see how it can be done as an individual yourself. If you're doing a very small capital raise, I can see it being very easily managed. Like, let's just say $500,000 and under. That's, if you can set up a fund of that size, which I'm not sure if you can, but if you could, that would be easy to manage because you probably don't have a lot of investors and don't have a lot of inventory to manage. Okay, that can be a one-stop shop type of person, right? But when you get over the 7-figure threshold, you can get quite a bit of inventory with that. I'd venture to say you can probably easily get 50 loans with $1 million.
Right. And you want to be, like with a lot of ventures, you want to set it up correctly from the start. I mean, our whole idea is to do volume, right? I mean, our eventual goal is to buy portfolios. Okay. In doing so, you don't want to have this cumbersome onesie twosie system where I'm not sure if you're putting in data or I'm putting in data. You have to have it very set and rote and do it one specific way and have it all be smoothly, or else it's going to come down around your knees and you're going to forget that you didn't pay Bill or Sally or Harry or whatever. And if you're doing partials like we are and not, there's just a lot of moving parts. There
is, and you can't shortcut anything. It needs to be done correctly. And in today's environment, it's instantaneous communication is crucial. And also having a system with a lot of really good processes in between there so that you have great quality control checks, that you don't have to have a ton of human interaction. You can have human checkpoints right throughout the process, but if you can automate more things and you can have things more streamlined and very clear as to what the next step is, it makes it really easy to get through deals one time as opposed to making mistakes and going back and fixing things. So luckily, with our experience with just buying notes ourselves and selling them, we have a lot of processes in place. It's just adding the component and the complexity of a fund on top of that to make sure that you're compliant and we're going along with what the rules and regulations are, which is the PPM and the operating agreement.
Plus, you want to make sure that other people can help you. So as we found out with our email system, we've got to design it not just for Richard and Justin. We've got to have it so somebody who's helping us, one of the staff people that we now have, can dip into some email account and do what they need to do and find out where we are. And if they leave, we can pick up where they left off and all sorts of fun things.
Yeah, it's running the business and running it efficiently. And that's what separates some of the funds being really successful than the others. If you're looking at it from outside the tower, everything looks nice. The building looks like nice and shiny. But when you go inside, the building and you just see, like, I can just imagine going to the stock room, the stockholders' floor room, there where they're trading stocks all the time and everything's going crazy and everyone's on the phone yelling and screaming and waving their ticket in the air. Like, it can be that crazy inside of an operation, but you can't tell from the outside. But having a very smooth process, a very good operation, a very clean, clear set of instructions that people are following, and you have good deliverables and receivables, it makes the fund a lot easier to manage, and number one, and then number two, to be profitable.
Right. And I mean, one thing, so let's not be just totally dismal about this. Let's talk about some upsides. The wonderful upsides is obviously you're not tied to a single asset. So
Right.
we can raise $300,000 from one investor, and it goes into the general pool. They have a diversified fund and set of loans that they have as security. And we can trade them in and out. We can say to them, look, you don't have to have a 10-year hold period. You can be a minimum of 2, and we can trade you in and out there. I mean, it's just, once you get it up and running well, it is a wonderful tool.
Yeah, from the outside, an investor's standpoint, or even a seller's standpoint, to sell us inventory, it's really simple. Okay, the investor puts in money, they agree to sign the paperwork, they understand what the paperwork says, and they basically get paid out on an ongoing basis as they're supposed to be paid. It's very simple and clean that way. And then we try to make it that way. If you make it too complex and you have a lot of different preferred returns and you have a waterfall effect and if this, then that type of stuff, maybe it may be a little bit more lucrative for somebody in the long run, but it's extremely complex and it has a ton of oversight on it. So that's not the first series of funds we wanted to do. We wanted to make a more simple, clean, easy to follow fund, and then kind of build on top of that to the next fund. That'll be maybe 2 or 3 times larger than the current one, and then just kind of go from there until we graduate to a very large fund.
Right. And that's the goal. And I really think from the way we're starting, we're doing it as right as we can in terms of getting our systems in place. And even if we have to swap out, I mean, I see us going to a much larger database at some point, a Salesforce or something like that. But even using 2 or 3 and melding them together the way we're doing now, we could still do quite a volume. I think we could probably do, I'm just guessing on this. We could probably easily do 50 million, maybe 70 million with our systems the way we're currently setting them up, and not be too strained.
Yeah, we definitely didn't want to chew off more than we can handle.
Right.
And so we start off with something manageable. That's why our fund size is a $10 million fund. So we feel like that's on the very low side of things on what we can do. And we just wanted to meet expectations and get through this. And we know the next time that we do a fund, we can make it much larger than what the current one is. And we can also get feedback from our investors on their experience as well, and move into the next one.
Right. So yeah, it's been a real learning experience. I think overall it's been a good learning experience, and I would certainly do it again. We sort of wanted to talk about this a little bit today because I think the market is ripe. I've talked to several different people in the note space who are hot to have a fund, and that's great. You should do it when the market conditions are right, and I do think that the market conditions are right, but it's a little bit caveat emptor, buyer beware when you get into it.
It is, and it's just like any other business or tradesperson. I think of them often as to where they're, the term like they're a glorified X. They're just a glorified person in that position, meaning they do the task extremely well, or the craft, or the trade, or the service. But they don't have the business skills to run a really good business. So that's why they only go so far with their business until they can take on a partner that can help them get to the next level, or they can get the knowledge and the training and the mentorship from somebody. And I think those two things need to go hand in hand, especially with a fund. You need to know the craft, number one,
right,
and then you need to know how to run a business, number 2. And I don't see how you can do it by yourself at a very high success rate without having either many partners or many mentors on a consistent basis that are helping you graduate, to the next level, to the next level, to the next level, to make sure that you have a good running business, because it doesn't work by yourself.
No, it doesn't work by yourself. And, there's a little bit of a metaphor there. So I taught at one of the local universities here for a while. I taught finance.
Professor Thornton,
if you can believe it.
Right.
Yes. I never really liked it when people called me professor. I'm going,
well, now I have to say it.
Yeah, now you have to. Anyway, I was teaching master's level finance, and I had a lot of fun doing it because we had a lot of people who were in finance for utility companies and things like that. And you could always learn a lot from them and their experience. But as I was doing the lectures and lesson plans and all this, I always found it very interesting at how much I had to know that was outside of exactly what I was teaching.
Okay.
By that I meant there was so much peripheral information that I had to know to be able to make the class come alive, the lecture to come alive, that you would think would have nothing to do with finance. But nevertheless, it did. It's just interesting sometimes. This is very much the same way. There's just a lot of things you got to know that it was really not core to the business at all.
Right. All right, Richard, I think we beat this drum pretty well today. So this was a great conversation. So I appreciate you being on today and taking the time to do this with me. And this is episode number 4. We are American Note Buyers. This episode and this podcast is brought to you by American Note Buyers, and we will see you guys on the next one.
Bye-bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.